So this is basically looking at the portfolio of alternative risk premia funds, HFRX Global, and a couple of the HFRX sub-indices from 2017 to June 22. And I'm explaining the performance, first of all, by the traditional assets, global equities and bonds, and secondly, by those risk premia strategy composites. And what we can see is that during that longer period, the risk premia funds at a headline level have relatively low exposure, especially compared to something like the HFRX Global, to equities and bonds. However, bear in mind that they do have the tail exposure in the underlying strategies, which comes through in the numbers below. Secondly, if we look at the performance up until the end of 2020 and see what's changed since then. So first column is the performance from 2017 to 2020. Second column is the performance from 2021 to June of 22, and this is based on weekly observations. What we can see is that the ARP funds actually had a negative loading, which is somewhat statistically significant, to global bonds. So they were making money when bonds went down. They've had consistent exposures to short volatility, to equity value, and to trend following, which obviously has explained a lot of what's been going on. If you look at the alpha number here, I would read that with some caution. So the composites are not fully costed. So this is not really saying that in the first 4 years here the funds underperformed by 2.8%. That's not taking into account all the fees. I would be more looking at the direction of travel. So the underlying strategies have performed better, but also the managers have done better than what you would expect from the pure statistical footprint of those managers. That's really the way I would interpret that alpha number.